Macro market trends, stock selection, ETFs, options. Just some of the topics covered in Cook's Kitchen.
Is it time to sell this market? Hi, I'm Kevin Cook in Cook's Kitchen. Let's take a look at some charts and try and answer that question. First up, we're going to look at the spiders, and I'm going to show you several charts. Some are breaking down, some are holding support. Let's see what's going on with the spiders right now. So this is a 3-month chart, and I've got 20, 50, and 100-day moving averages on here. I also have a special moving average called a volume adjusted moving average, and it's the 50 period. That's the green line you're looking at on this chart. Notice price is below the volume adjusted moving average, the 50 period, and it's sitting right on the 50-day moving average. All right, two other things I want to point out here. Areas of extreme interest where there was prior balance in the market. This 1540 to 1560 level, you can see that would be roughly 153.50, almost up to 156 on the spiders. The market is finding support there. It probably will continue to find support there, even if we quickly penetrate it on a given day. Next area is the red ellipse. That was roughly 1500 to 1520. That is an area also of extreme interest where I think that demand will overwhelm supply. In other words, this market is not going to fall out of bed here. There's still a lot of institutional interest. Even though we're seeing institutional distribution, there are many institutions who are still buying this market with positive expectations about earnings and the economy. So this market is not going to slice like butter through the 1540 to 1520 area. There's going to be plenty of buyers. All right, next let's look at the IWM, the Russell 2000, and we'll look at the tracking ETF here. This one is obviously breaking down quite a bit, well below the 50-day moving average. You can see the volume distribution. I've drawn a line here around 89 on IWM, and that corresponds to just above, or just below rather, 900 on the Russell 2000. Remember the way the tracking ETF corresponds to the index itself, it's about 1/10, but as time has passed, expense fees have built up, and so if you multiplied the IWM by 10, you'd see there be about a 7-point discount right now between the Russell 2000 and the IWM. So we speak of the 890 level being synonymous with 89, and there's roughly a 7-point difference there, discount on the IWM. So that's one that's breaking down. Next, we want to take a look at the NYSE index, NYA, and this is the NYSE composite. This one is also breaking down. So while the S&P 500 seems to be holding up, we've got a broader index of blue chip stocks that is that's showing some breakdown here. And again, 20, 50, and 100-day moving averages. I've drawn a line at 89.50 on the NYSE composite, because I think that's a pretty significant level where it was resistance. It's become support. Recent closes have been above there, but you see, we've penetrated that a couple of times and bounced off of 8,900. So this is a weaker index, and if 8,900 goes, then this market is really in trouble. All right, next let's take a look at one sector, and that's energy, one of the weakest ones here. Sell-off in gold and then oil comes down hard too. So you've seen this precipitous drop in the XLE, the energy sector spider, and this one's pretty ugly. And I tried to buy this dip, the big dip that we had on Monday, where it went below 75, and it's just been some more pain since then. Now, as oil continues to drop below $90, the energy sector is going to be weak, and that's something we have to keep an eye on. But this one is so oversold, and if you look on a 3-month basis comparing all the sectors, energy is, the only thing that's weaker is materials. So there's possibility of a bounce here, but you want to be careful playing that with leverage. All right, next let's look at the German index, the DAX. Now this one has really fallen apart recently, and I want to highlight the fact I'm showing here its correlation to the S&P 500. Or actually, I've put the black line behind it is the S&P 500. So obviously they're positively correlated, as a lot of equity markets are. You can see what's happening here, though, is the DAX is taking out a resistance level from September through November, and this is actually a chart as of yesterday's close, as of Wednesday's closed, April 17th. The DAX this morning has been below 7,500. So this is a lot of weakness here in European markets, and could be foreshadowing more weakness here. Probably will find support near its 200-day moving average, just below 7,400. All right, next up, let's look at an indicator of breadth. Last week we looked at a lot of breadth indicators. Now I want to look at just one today, and that's percentage of stocks above their 50-day moving average on the S&P 500. So we call this a moving average breadth indicator. And I'm showing it as a histogram, 1 year, so you can get an idea of the context of what happens during sell-offs. We had the correction last May into June, so you can see what that looked like. Then pull back in October, November. Now what's going on here? Last week we looked at this, and the market was surging. We were back above 75% of S&P stocks above their 50-day moving average. Now, yesterday, this is yesterday's close, it closed at 54%. But today, it's probably below 50%. Now, one thing I want to point out here with this 50-day moving average business is that, as markets rally and they mature, the 50-day moving average tends to catch up to price. So as price slows down and starts to go sideways, the 50-day moving average is coming up there. So it's pretty normal for a lot of stocks to slip back below their 50-day moving average, in the context of a broader bull market. So it's nothing to panic about here. And I mentioned the NYSE as being weaker. The NYSE closed at 44% of stocks above their 50-day moving average yesterday. Very weak there, probably pushing 40 today as we have a little bit of a sell-off Thursday morning. But I see a bounce. Okay, what's the big picture from all this? Does all this add up to evidence that now is the time to sell your stocks? I don't think so, because I think what can happen here is the S&P is testing this 1540 level and finding out where the demand is and how strong the bears are. And what can probably happen is we puncture it, and we'll find even stronger support anywhere near 1525.30, and this market can actually rally back up to new highs. This is a phenomenon that's been going on in markets in the past few years where old school technical analysis doesn't work like it used to, where you find a level of support or resistance and you look for a breakout up or a breakout downward. What happens is you're getting expanding ranges. The ranges just keep getting bigger. It looks like you go down and challenge support, break support, and the market rallies back up, takes out the old highs. So these are what are called expanding triangles or broadening wedges. And that is a very common phenomenon here, and it happens in indexes, it happens in stocks, and it's something you really want to pay attention to before you run out and sell your stocks. We want to really see how levels on the S&P near 1525.30 hold. All right, that's all for today. Keep an eye on the broadening wedge. I'm Kevin Cook. Thanks for watching Cook's Kitchen.